die Jungs, die stören so mit dem Party. Ich gebe eine richtig fette Party an. Und dann ist ein Typ, der da eigentlich, glaube ich, auf der Bank kennt oder
Sind wir live?
Ja.
Okay, hi everyone. We are live now. Thank you. So hi, welcome. My name is Patricia. I lead Solana Super Team Germany.
Hi, I'm Carlo. I'm community lead and doing events, partnerships for Super Team.
So I know we have a couple new faces here, so just a couple seconds on what Super Team is and what Solana does. So we are the talent layer of Solana. So this is the way Solana organizes their community and their ecosystem. And as part of this, we have guest speakers and we have members of our community organize workshops. For example, the one tonight that Radko is hosting. So I think without further ado, you can kick it off. And thanks all. If you have questions, I think you can ask anytime. Is that okay?
Yeah.
Yeah, so just raise your hand.
Like in school.
Exactly. And those of you watching online, there's a chat on Twitter and YouTube. Post your questions there, and then we will also try our best to take them right away. Okay.
Cool.
Enjoy.
Thank you. So welcome everyone to the talk on Beyond VC, launch your funding with tokens. And I'll try to give you like an end-to-end, almost like a playbook, how to launch your funding and as an alternative to VC funding. Bit of an introduction to myself. So everybody calls me Radko. I'm the founder and CEO of a company called Bitbond. We've been in the crypto space for quite some time. I started the company in 2013. We provide tokenization software, which is one of the many components that you need in order to launch a token sale. But I can also speak of experience. I've raised around about 6 million euros in VC funding for Bitbond. And with Bitbond, we launched Germany's first regulated security token offering, where we raised over 2 million euros. And I'll speak from experience from our own token sale, but also from other token sales, obviously, that are happening in the market. Besides running Bitbond, I'm a lecturer at Goethe Business School in Frankfurt. I'm on the supervisory board of University Witten-Herdecke. And before I started Bitbond, I worked in consulting with Roland Berger, and I was in sales and trading at Deutsche Bank London. So I have pretty much a financial services background. Online, you can find me on LinkedIn and on Twitter. But now let's get started. Token-based funding can be a pretty good and even superior alternative to VC funding. VC funding has, of course, been the main source for capital for early stage growth businesses for pretty much the last, 20, 30 years since ever tech startups existed. And VC funding is not a bad way to get funding. However, it has a few disadvantages. One of the disadvantages is it's typically a very lengthy fundraising process. Of course, some of the best companies can raise within a few days, but for the big majority of companies, fundraising takes a lot of time. Plus, VCs take a lot of control. In a typical funding round, you will give away around about 20% of the ownership of the company, which is not too bad, but at the same time, VCs, through the agreements that they make with you and your company, will have special rights like liquidity preferences and other control rights that give them a say in decisions in your company, even though they may not be the majority shareholder. Plus, they have very high return expectations. A VC fund normally needs to return around about 3x the money that it raised. However, VCs operate with a high default rate because, of course, investing in early stage startups is risky, and the fund winners rather have to deliver something like 100x return in order to make up for the losses that they normally make in their fund. So these are the expectations, and you have to be aware of that when you raise funding from venture capitalists. Now, as an alternative to that, there is token-based funding, which has a few advantages. First of all, you can have a very large, a broad and diversified investor base, because typically, depending on how you structure your token sale, you can address pretty much a global audience maybe with the exception of the US, which is a special kind of animal when we talk about token sales. But other than that, you have a very large potential investor base that is very diversified before you. One advantage also from the investor standpoint, and this is true for both for retail as well as institutional investors, is liquidity. When you invest into tokenized assets, typically they get listed on decentralized exchanges immediately, sometimes even on centralized exchanges, which means that investors can buy and sell the token. While with VC funding, until there is a liquidity event like an exit, so another company acquired you, or there was an IPO, or in some cases there are secondary deals, but these are rather the exception. The investors are locked into that investment typically for many years. Other positive aspects of token-based funding are incentive alignment. So typically we will talk about that when we will speak more about what types of tokens you can actually issue. But in most cases, the incentives and the interest between your investors and you as the company that is raising funding is very much aligned, and the investors will often, if you manage it well, actually help you to grow your business because they might become users and early adopters of your product. So these are some of the advantages. Also, on the other side, you don't give away as much control as you do with VC funding. So there's a lot of good things about token-based funding. However, as we will see throughout this presentation, it doesn't come for free. There's also work and effort that you need to put into it in order to raise successfully based on tokens. But regardless of that, again, the fundraising process with VCs is very lengthy. In the token-based funding, you have a bit more control over what's happening. So all in all, you can be a bit quicker. Now, when should you raise token-based funding? This is a big question because if you look at the life cycle of a tech company, you go through different stages and you go through different growth paths. Your metrics like revenue, number of users, number of employees, traffic, and other top-level KPIs that you defined for your company will be growing. And in different stages of the growth, different types of funding are appropriate. At the very beginning, typically bootstrapping and funding from your own capital and from family and friends is the way to go. This stage normally is too early to raise token-based funding. Of course, there are always exceptions to the rule, but generally speaking, this is too early. Why? Because you do need to have something to show to the investors. The same way VCs will want to see some early traction, some early users. The same is true for token investors. There have been examples where companies just based on a white paper were able to raise multiple millions of dollars, but those are cases that may have very experienced founders who have founded and exited one or even several businesses. So those types of founders can raise more easily. But if you are a first-time founder or even a second or third-time founder, but you haven't had a big exit, then typically in the very early stages of your company, a token sale is not the right method, but you're rather bootstrap. Then the next stage, which is seed and Series A, B, C stage, those are typically the phases where token-based funding is feasible and where you should think about it as an alternative to VC. Because these are also the stages where you typically would think about VC funding. And so this is where you should consider token-based funding. And then when the company is very mature, typically you want to exit, you would sell the company to something like private equity firms, or you would go public as part of an IPO, an initial public offering. So in these cases, of course, token-based funding may also not be the appropriate thing because typically you are looking for much larger amounts of capital than in the earlier stages. Also here, there are exceptions to the rule, but most of the time it's these two stages, seed stage and Series A, B, C stage, when token-based funding is a good alternative to VCs. How relevant is token-based funding? Well, it might be more relevant than you think. In 2024, around about $2 billion worth of funding have been raised through token sales, mainly through ICOs and IDOs. And this, by the way, excludes meme coin launchpads like Pump Fund, Pink Sale. So this is really company-style funding and not meme coin-style funding. And there have been over 800 successful ICOs, which is quite a sizable number. If you compare that to the total amount of VC funding that has been raised in 2024, then it's around about 2% of that. So it's not a big chunk of the total early stage funding. However, VC funding also includes Series B, C, D stages when it may be a little bit too late or too mature for token-based funding. So I think a fair comparison would be if you only looked at early stage seed, Series A type of deals. This is when typically token-based funding is an alternative. And there, I don't have concrete numbers to show, but my rough estimate would be maybe even 10% of early stage seed Series A funding comes from token sales. So it's definitely a very relevant source of funding. Now, one thing to think about in the context of token-based funding is what kind of token do you actually issue? Generally, there's a lot of different categories of tokenized assets. Stablecoins is by far the biggest one with over 200 billion of market cap. I'm sure everybody in this room is aware of stablecoins. Then there are utility and DAO tokens. This is one of the relevant categories for token sales. Then there are NFTs. NFTs at a time were also kind of a fundraising method, but the NFT market is down pretty much, and it still exists, but it's not really relevant for early stage funding by and large, I would say. Then there are security tokens. So these are tokens that represent a security like a bond, a stock, a fund share. These are also highly relevant for token sales, as we will see. Then there are real-world assets. These are typically issued by larger issuers that want to bring assets that already exist on chain. So these are not super relevant for token-based funding. And there are meme coins. There are some companies that are kind of on the brink of between being a utility token and a meme coin. So these definitions, of course, are never perfectly clear-cut and exclusive of each other. But if you look at the bigger meme coins, then you will see that they have not been created for the purpose of token-based funding, but rather of creating an investable asset that simply follows a certain idea, or a meme, as the name implies. So let's dive in a bit more into the two token types that are relevant for token-based funding. First of all, utility tokens. What are utility tokens? Utility tokens give the owner the right or the access to a certain product or a service. Utility tokens often can also be called a form of a platform-specific payment method. So I listed a few examples of utility tokens. The biggest one by far is the BNB coin, the Binance token. Why is it a utility token? Because when you trade on Binance, you can pay your trading fees in BNB. So this is the largest utility token out there. I'm actually not sure whether Binance did an ICO, so they may not have combined it with a token sale, but the token as such is a utility token. Utility tokens do not promise any returns. They are not paying any dividends, any coupons, or anything like that, but they may go up in price when the usage of the underlying platform goes up. So to stick with the Binance example, obviously this is not the only factor that will determine the price of the Binance token. However, as Binance grows as an exchange, more and more people trade on Binance, they will potentially buy more BNB tokens in order to pay their trading fees. So there's definitely a relationship between the success of the underlying product and the demand, and therefore the price for the token. Utility tokens for a very long time have not been regulated, but Europe launched something that's called MiCA, the Markets in Crypto Assets Regulation, and it also covers utility tokens. So they are not unregulated. At the same time, they are by far not as strictly regulated as security tokens, as we will see in a minute. And I can already say right now, for most crypto projects, utility tokens are the way to go and are the best method if you want to raise capital through tokens. Now, as a second method for token-based funding, we have security tokens. Security tokens are just a tokenized form of a pretty traditional security. Typically, either equity-style funding by selling shares in your company, or debt-style funding by selling a tokenized bond. And through the nature of being a security, all of the common and normal securities regulations come along with your token sale. One of the core components here is a securities prospectus. If you want to make a public offering of a tokenized security, you will need a prospectus, which is a long-form document, around about 60 to 80 pages, fairly expensive. A lawyer needs to write that because nobody with a law background could really do it in a compliant way. And so the effort to get started with a security token is higher. And most of the, let's say, relevant security tokens out there have actually been issued by larger corporations. In 2024, for example, Siemens issued a 100 million euro tokenized bond. Siemens obviously being a very large corporation, they don't really care about the legal fees because in the context of the fundraise, it doesn't make a huge impact. But we also at Bitbond, the company that I founded, we launched a security token. In fact, we did the first tokenized security that received regulatory approval in the German market. It was tied to the business model that we had at the time. So for us, it made more sense than a utility token. And it was worth the effort for us. But when you are in the decision-making process, when you want to fundraise with tokens, I would really advise you to take a look at the costs and benefits of both of these options. And again, for most crypto projects, the utility token is the way to go. Now, before you launch your token, you should ask yourself, are we as a company, are we as a team ready for a token sale? And there's a number of questions here on the slide. You don't need to have perfect answers to all of these, but for some of those, you really should be ready. You should have a good clarity about your growth goals with the company. Do you really need funding or do you want to bootstrap? What is your traction? How appealing is the vision of your company? Is this something that retail investors will understand and will find attractive? How active is your community? This is one of the most important questions, I would say, because your community and your users and your customers will probably be your main investor pool. And if you don't have a big community, it will be much harder for you to raise capital through a token sale. How does your team look like? Is this something that is presentable based on the experience that they have? Do you have product market fit? Together with the community question, probably one of the most important questions, because typically you want to promise credible growth projections to your investors. If you don't yet have product market fit, then this will be very hard to do because you are still experimenting and trying to figure out what should your product actually look like, what is your positioning in the market. And again, it definitely helps to answer this question with a confident yes if you want to run a token sale. Decentralization, another important aspect, also has a lot of legal implications. I'll speak about that a bit later. Can you decentralize your token and your company in a way that the founding team at some point becomes almost irrelevant? And also, how do you make money and how urgently do you need the money? Could you turn the company break even if you had to? This will also have a lot of implications into how confidently you go into your token sale and how much investors will be interested. If you feel you're ready, then you will need to go through 6 steps if you run a token sale. Each of these steps is a pretty big chunk of work, and we could easily spend an hour on each of these 6 steps. And I tried to condense it into more of a half an hour, 40-minute kind of talk. So again, I'm happy to discuss these with you, and you will see that I had to leave out a lot of detail in order to condense it. But I tried to put the most important aspects for each of these steps into this presentation. So we'll start with looking at how do you define your project and your token. Then we will look at how you define your tokenomics and your sale type, because there's different types of token sales. What means putting together your offering material, then the operations that you need, what do you need to consider there, then marketing, another very important aspect about token sales, and then what happens during the execution and in the post-sale part. Because when you have a token out there, it doesn't finish with the sale, but it's rather the beginning of a next phase in your life cycle. So let's get started with the project and the token. First of all, you should define very accurately what does your company do? What is your project actually about? What is its purpose? Why is that so important? Because that will inform what can be the purpose of your token that you want to launch. In the case of a utility token, your token will give the token holders rights and access to products and services. And so you have to define how well does a token fit into the setup, into the mechanics of the company and the product that you have. And this is something that you will have to define very early on, because once you have defined what the token actually does and what it is, only then you can prepare the other steps of the token sale. If you go for a security token, you will need to define, is it equity? Do you want to sell shares in your company, or is it debt? Do you want to raise capital that you will have to repay at some point in 5 years, in 10 years, whatever is the maturity of your bond? You will need to define what kind of dividends do you want to promise to your investors, or what kind of coupon payments, which essentially is the interest that you are paying on a bond. So all of these things you will have to be aware of. You should also start thinking about what are you planning to do with the proceeds, so with the funds that you raise as part of the token sale, because investors will want to know that, and you should have a very good answer to this question. So this is the project and your token. This is how you get started, thinking about what does your company do, what will be the purpose, the role of your token. Now the second step, where you define your tokenomics and your token sale type. Now, what is tokenomics? Tokenomics basically defines who receives how many tokens when you have launched your token. You also need to define the total supply, because this is not just percentages, but you need to know the absolute number of tokens that will exist, and what that amount is going to be. Because then from there, you can also derive at what price do you want to sell the tokens. Because once you have your tokenomics pie chart, I'll show an example in a moment, you will say, well, I don't know, I want to sell 10% of the total token supply as part of the token sale. If you have 1 billion tokens, that would be 100 million. 100 million is the number of tokens that you're selling. If you want to raise $100 million, then obviously you would have to sell for $1 per token. If you want to raise 10 million, you would be selling for 10 cents per token. So you need to be aware of that. At the same time, you should already think about what kind of market cap or fully diluted valuation does the price imply, because this will also have a lot of implications on the trading that's happening after the sale. So these are things that you have to think about early on when you define your tokenomics. One other important aspect in the context of tokenomics is the vesting schedule. You typically do not hand out all of the tokens at once. This is also common in other tech startups that are not raising funds through a token sale. The founders should show that they are committed to the company and not get their token allocation right at the start, but you would typically use something that's called a token locker, where you lock up tokens and they are released over time. I'll also show a release schedule in a moment. That will hold a large stake of the token supply. Why is this important? Because investors want to understand whether there are individuals or potentially institutional investors that control a large chunk of the token supply. Because they could dump and sell tokens, which would make the price crash. And obviously, investors aren't doing this just for fun, but they are expecting returns on their investment. And they can expect returns if those people who are holding and buying tokens will not be selling them immediately in large quantities. Besides the tokenomics, the token sale type defines how investors actually obtain tokens. There are different ways to sell tokens to the public, and I'll talk about that on a dedicated slide. Now, let's look at an example tokenomics chart. This is based on the example of Uniswap, the Uni token, which was released, I think, around about 2 or 3 years ago. So Uniswap is the largest decentralized exchange. They launched a utility token called Uni, and here we can see the initial allocation. They allocated 60% to the community. A lot of exchanges and even other platforms do it like that, They want to incentivize usage of their product even before the token is out. And so they promise, if you guys use our product, you may be entitled to an airdrop, for example, and we will allocate a lot of the tokens that we release to you, even though you don't need to buy them. But then also other parts were allocated to the team and to investors. So because they also used it as a method for fundraising, and I think even some of the VCs that they raised got a token allocation. So this is just one example. There's plenty of variations of a tokenomics schedule. One thing that can also be done, by the way, this is a little side note. Some companies release tokens without a token sale. So they just give out tokens to its users, and then the tokens at some point through trading acquire value and become valuable. And then if you hold a good number of tokens in your treasury, in your company, then you can start to sell a few tokens through the general market, through a decentralized exchange, for example, and use that as an ongoing fundraising method. So that's an alternative way. However, this is not really suitable if you want to kickstart your company and you need to raise, I don't know, 1 million, 2 million, 3 million of capital in a relatively short amount of time because you want to fund product development and marketing with that capital. On the right-hand side, we see the release schedule of the Uni token. And you can see that initially, only a bit more than 10% of the 1 billion total token supply were released. And the reason for that exactly is that they wanted to make sure that not a lot of tokens get sold immediately. So they allocated it through a vesting schedule, not just to the team, but also to the community. The red part of the chart is the community allocation. And so you see also the community didn't receive all of the tokens at once. However, they did that very successfully. I don't know if you can read it back there, but Uniswap right now has a market cap of 3.6 billion. And it has a fully diluted valuation of nearly 6 billion. Why is that? Because only 600 million of the 1 billion total token supply is circulating, which means it's being traded and someone can actually move these tokens. The rest, the remaining 400 million, are in some way locked up and are therefore not part of the circulating supply, and therefore don't account into the market cap calculation, which gives them a market cap to FDV ratio of 0.6. This is considered not a really good ratio. You want to get much closer to 1 because investors can potentially fear that someone who is a whale, at some point will unlock a big chunk of these 400 million locked up supply and start selling, which would create a lot of price pressure. So typically, when you do a token sale, you want to have a very high FDV ratio, market cap to FDV ratio, more towards 0.8, 0.9. So this is also something to consider. But Uniswap, having been by far the most successful decentralized exchange, they can pull off such a rather unfavorable market cap to FDV ratio. Now, let's talk about the token sale types that exist. So this is not an exclusive list, but these are definitely the most common ones. ICO, IDO, STO, and fair launch. And not all of these are equally relevant, by the way, when you run a token sale. An ICO stands for initial coin offering. Typically, that's an offering to the public of a utility token. And this has in the past been the most common way to run a token sale. The ICO has one disadvantage. It doesn't guarantee the investor's secondary market liquidity. So they buy the token, but they don't know whether there will be an audience, a market, where they can also sell the token again. Sometimes ICOs are conducted in combination with a so-called IEO, an initial exchange offering, in which case the ICO company has signed a deal with potentially a centralized exchange that will guarantee that at some point they will list the token and it will be traded there. This is a very strong signal, and those ICOs that have been successful often had such a partnership or agreement with a centralized exchange already signed as they did the token sale. What you have to consider, though, is that the listing fees on centralized exchanges are typically really, really high. So this is something that you need to be able to afford. Some companies even did a pre-sale only for the purpose to have enough funds to spend for marketing and for centralized exchange listings. This has changed over the past years when IDOs came up. IDO stands for Initial DEX Offering. It's very similar to an ICO, with the important difference that during an IDO, the investors know that immediately after the IDO finished, a liquidity pool on a decentralized exchange has been funded. And this is not in a way that the investors have to trust the company to do that, but this is regulated directly through the smart contract that you use during the token sale. Because as people invest into the token sale, the smart contract will automatically allocate a certain percentage of the funds that were raised into the liquidity pool. Ratios of up to 80% are not unusual. So if you do an IDO, as a company, you will define what percentage of the funds goes into your treasury, so can use that capital in order to develop your product, etc., and what percentage goes into the liquidity pool. Some companies choose 10%, some choose 20%, but some go as high as 80% in order to signal to the investors that there will be a lot of liquidity and that they will be able to sell their tokens if they wish to do so. And therefore, an IDO has pretty much a guaranteed secondary trading as part of the token sale, and therefore this is the recommended method. Obviously, everything depends on the concrete situation of your company, but generally speaking, I would recommend the IDO way of token sales because it simply gives investors confidence that there will be a certain level of secondary trading possible. Ultimately, everything that you do as you design your token sale, you want to give assurance to investors that you are a credible project, you have a strong team, that your tokenomics are fair, the incentives are aligned between the team, the investors, and the users of the company and the product, and that there is secondary trading and that there will be no price dumps. So everything that you do is kind of geared towards assuring investors that they will make a good return on their investment, because this is ultimately what investors want. There's also an STO, a security token offering. STOs are typically conducted in a way like ICOs, only that the underlying instrument is a security. So you sell tokens to the general public, and in most cases, there is no guaranteed listing of the token. However, in some cases, also for STOs, there is an exchange listing already agreed prior to the token sale, and some STOs can also be traded on a decentralized exchange. The token sale that we did with Bitbond, we've done it on a Stellar blockchain. It was back in 2019 when Stellar was the chain with the lowest transaction fees. And it wasn't an IDO, but immediately after we finished the token sale, we listed the token on the Stellar decentralized exchange. And up to this day, it's being traded there. So you can also combine an STO with kind of like an exchange listing, but it's a bit more complicated because the regulatory hurdles are simply larger. And then there is the fair launch. A fair launch is typically not used in the context of raising capital through token sales, but it's still a very interesting method. Typically in a fair launch, you sell all of the token supply. So you don't keep anything in the treasury, you don't have any early allocations to some bigger investors, but you take the entire token supply, you let people buy it, and then at the end of the day, an average price crystallizes, and everybody gets tokens allocated to the same price. This is typically done in the context of meme coins. For meme coins, it's very common to do a fair launch, but also when you launch a network token, it's typically done through a fair launch. The very first example of a fair launch was Bitcoin. When Satoshi Nakamoto released Bitcoin, it was not pre-mined. Satoshi Nakamoto did not hold any Bitcoin on the day of release of Bitcoin. But the moment he released it, everybody was able to download the Bitcoin client and could start mining Bitcoin. So it was a fair process and nobody was preferred. Obviously, Satoshi knew it, so he had a bit of an information advantage, and probably not a lot of people were really interested in Bitcoin at the time. Maybe just a few people in the cryptographic mailing group that he was part of. But again, early on, there was nothing pre-mined. Everybody had the same conditions from the very beginning. And there were a few other tokens that were launched as part of a fair launch. On to the next one, offering material. This is a relatively boring topic, but a very important one because it can keep you out of jail. If you don't get your offering material right, then investors may be able to sue you, the regulators may be able to sue you, and you can get into a lot of trouble. The type of offering documentation that you need is determined by the legal classification of your token. So here, it plays a very important role whether you decided to go for a utility token or whether you decided to go for a security token. I would definitely discuss this question with a lawyer. So this is one of the things where I would definitely advise you to take external help because every situation is slightly different and you should not just rely on some internet search, but I would speak to someone who's qualified to talk about this. In the case of a utility token, you will need a white paper, especially when you do that in a European context where, as I mentioned earlier, utility tokens are now regulated under MiCA, Markets in Crypto Assets Regulation, and there are certain requirements around the white paper. It will need to contain the description of your project, what do you want to use the funds for, some risk disclosures as well, et cetera, tokenomics. But a white paper is a relatively manageable type of document. You, as a founder, you will typically know more than enough about what you are planning to do in order to put together a good white paper. In the case of a security token, you have to do a securities prospectus. And this is much more complicated to put together than a white paper. And normally you will have a lawyer write that for you, which makes it also a lot more expensive. If you write the white paper yourself, then the cost is essentially the time that you need to invest in it. A securities prospectus can cost anywhere between 30,000 up to 80,000 euros. So it's, the hurdle to do that is much, much bigger. And you also need audited financial statements, for example. So it's not enough to say, well, this is what the P&L or what the revenue of my company looks like. You have to have audited financial statements. Getting an audit done, it's easily another 20, 30K. So the costs just, start to build up. One thing from a European perspective that I would definitely advise everybody to do is not to actively sell tokens in the US, unless you are 100% confident that you can do it. But these cases are rare and typically incur a lot of legal costs. So this is a thing that, I would always consider when you do your token sale, exclude US investors, again, unless you went through the entire process that's necessary to get that approved. Let's take a look at a white paper example. This is a screenshot of the table of contents of the white paper of Basic Attention Token. Basic Attention Token did a ICO in 2017, a very successful one. They raised $35 million. But they also had a very strong team, I have to say, and they were tied to the, up to this day, are tied to the Brave browser, because the Basic Attention Token is a utility token that is used to pay for ads and for consuming ads within the Brave browser. So very interesting concept. The kind of almost a blueprint for what a utility token can look like. Today, the market cap is at 220 million. The all-time high has been more than 10 times that, but it's one of the successful early ICO projects. And when you look at the white paper, you will see that mostly they talk about the problem definition and what the product is solving. So the token launch is just one part out of the white paper, but the main thing is to convince users and potential investors why they are solving a relevant problem and why they have a great solution for that problem. So in your white paper, you will want to focus on, what's actually happening in your product and what kind of utility does the token really provide. And obviously, there's plenty of other white papers out there on the internet if you're looking for some samples. Any questions so far?
selling tokens to US investors, does this affect NFT sales as well?
Well, as a one-size-fits-all answer, I would say yes, any type of token sale. However, NFTs in the original sense, where each NFT, even if they are done under the same smart contract, are a different image, are very far away from being a security. The risk that you have when selling tokens in the US is that the SEC, the Securities and Exchange Commission, will regard you as a security, in which case this is very, very risky for you. With NFTs, the likelihood for that is very small. So with NFTs, I would probably take a different stance. I would still consult a lawyer probably. But with NFTs, you have a high likelihood not to be in securities territory.
Okay. One more question.
Sure.
In the MiCA regulation, how is for example, if I sell an NFT and then I put it on the secondary market with the royalty, how is that regulated in MiCA?
As far as I know off the top of my head, NFTs are not covered at all by MiCA. I think they left it out. And I mean, the NFTs, you can look at them as artwork. Again, otherwise unless they are structured in a security type of way where, you know, all of the NFTs are the same. But if they are NFTs in the kind of original sense of digital art, then the royalty is simply a revenue stream for the creator, and doesn't really make it a security. You know, one of the characteristics of the security is that you make a promise to investors that they will receive some kind of a payment in the form of interest or a dividend. But the royalty is not something that's promised to the investors, but that's something that goes to you as the creator. Therefore, again, it doesn't really bring you into the securities territory.
Some NFT projects have revenue sharing attached, and that puts you firmly into the securities camp in the States.
Okay,
so it really depends on what your NFT does and how it's structured, and not so much about the difference between NFTs and the token, because technically an NFT is just a token.
Right. So about the end, the revenue share.
When it's promised to investors or NFT holders, then that's different, right? Because then you make promises that they will earn something, and that's where it gets more complicated for you as the creator, right? If the royalties just go to you as a creator, it's simple. If it goes or is promised in some form to the investors, it's different.
I have a question. So what is the part of the donation as tokens part? So how do you cover this? Like,
What kind of donations?
for example, can you tokenize it, or can you, well, what if people want to do donation with tokens or something? Is it a legal part for this? How does it work?
I mean, in general, if you are selling tokens, you should always consult a lawyer. If you give away tokens for free and there is no promise behind that token to pay something, to do something, then you are relatively safe. That's what meme coins are, right? Meme coins don't promise anything. You buy a meme coin, and I mean, obviously you hope that it will go up in price. That's normally one of the main reasons to buy a meme coin. But the person or the team that created the meme coin, they don't promise you anything. They will say, let's take Dogecoin, one of the first and the biggest meme coins out there. The creators of Dogecoin created it just out of fun to show how cryptocurrency works. Bitcoin at the time already had a price, but they wanted pretty much to give away Dogecoin for free. And they just said, we have this beautiful, nice dog that everybody finds cute. Let's, create a token for that dog. And that was it. But there was no promise. Nobody ever said, well, Dogecoin is going to go up in price. We're going to let you participate in any kind of success of a company. Nothing like that. It's just a token that has a nice name, a cute image potentially, and that's it. So there you don't promise anything. That's a meme coin, and meme coins are fairly safe from a legal standpoint. The moment you start to promise stuff and attach certain rights, or financial gains to the token. Then the legal side gets a bit more complicated.
Non-profit projects are basically meme coin projects?
It depends what the token does, right? A non-profit project could still use a token to fundraise, but then again, it depends. Do they promise anything to the token buyers? That is the big question. Are you promising them anything, or are you just telling them, give me money as a donation, and by the way, you will get a meme, you will get a token? Then that's a meme coin pretty much, right? Because you don't promise anything. And by the way, I'm saying meme coin here without judgment. I'm not saying this is a good or a bad concept. That's simply what it is. You're giving out a token. You could give it out for free. You can even give it out for money. But as long as you don't promise anything, it's a meme coin.
Okay, thank you.
Great. Then let's continue with operations. So in order to run your token sale, you will need several components on the tech side and in other areas. Now, my strongest advice here is do not reinvent the wheel and do not develop stuff yourself where there are ready-made solutions in the market. Obviously, this is true for the blockchain, unless you are starting your own chain, obviously, and that's the purpose of your project. Then this is different. But in the case of the blockchain, obviously here we're here with the Solana super team. So Solana is a very good choice, but it indeed is a very good choice because it's one of the most active chains. And besides Solana, Ethereum and Base are by far the biggest chains in terms of activity, like trading volume, investors with money on that chain, transaction volume, etc. So these three chains, Solana, Ethereum, and Base, would be my go-to picks, and I would almost say it's not really worth your time looking at other alternatives, at least not right now. Obviously, this is something that evolves. Next year, this could look differently, but this is where we stand right now. If you follow the path of an IDO, an initial DEX offering, you will need to choose a decentralized exchange that you want to list on. I would definitely opt for the ones that have the largest trading volume. So if you go to Ethereum, you would want Uniswap, most likely. Then within Uniswap has different versions out there because it has developed a lot over the last years. Right now, everything is going to the third version, the Uniswap protocol v3. So that would probably be your DEX of choice. In the case of Solana, Radium is by far the most active decentralized exchange. So probably if you do an IDO on Solana, Radium would be your DEX of choice. Then you need to create your token, and you will also need other smart contracts. Now, in the early days of ICOs, everybody went out, hired software engineers to write the smart contracts from scratch. Today, the good news is there are token generators, smart contract generators, where you can configure these smart contracts through a convenient user interface instead of having to program themselves. And that's exactly, by the way, what we do at Bitbond. We have a product that's called Token Tool. You go to Token Tool, you configure the smart contract through a user interface instead of having to do the coding yourself. When you do your token, one thing to keep in mind are so-called token scanners. Once your token is out, people will not just be interested in the, let's say, economic and business aspects of your token, but also in the technical security. The good thing is that token generators typically operate with audited smart contracts, so you don't need to do the audit yourself. And I'm talking about the technical audit here, by the way, the smart contract audit. However, there are also scanners that look whether there are honeypots or other security flaws in the smart contract. And sometimes you may have certain settings on the token that are not a real security risk, but that could be an economic risk to the investors. To just give you one example, what I'm talking about here, you can create a token which has a fixed supply, and you will never be able to mint additional tokens because that's simply how the smart contract is designed. But you can also create a token which has the mint function activated, in which case, after the token has been created, you can mint additional tokens and increase the supply. This is, of course, a huge risk to the investors because they never know when you will just create new tokens out of thin air and dilute them, in which case the value of their investment will drop. And therefore, it's very common for utility tokens to not activate the mint function so that investors know for sure you cannot dilute them by minting additional tokens. There's plenty of more token settings, but this is something I would always keep in mind. How does the investor look at your token once you have released it? Then, as I mentioned in the context of tokenomics, you will want to have a release schedule, so you will need a token locker. Again, that's a smart contract. You could program that yourself, but you can also get it from a smart contract generator. Then you will need a ICO, IDO, token sales script, as it is called. So that's a smart contract that pretty much manages the entire orders and the payments. So you could define USDC as the payment method, for example. So all of the investors that are buying your tokens in the token sale will do that with USDC. The smart contract of the IDO will keep that, will allocate the percentage that you determined to the liquidity pool on the DEX, and will make sure that you as the token sale creator can withdraw the funds after the token sale has finished successfully, while the investors will be able to claim the tokens that they bought. This is a pretty complex smart contract. And again, you can program that yourself, but it will cost you thousands of dollars in developer fees, or you can go to one of the generators and get a template. You will also need potentially investor onboarding with KYC. So one thing that you can do is you can say on the token sale contract, only wallets are able to invest that have been whitelisted previously. And only those wallets can actually buy tokens. But in order to do the whitelisting, you have to channel the investors through a KYC or KYB, know your customer or know your business. Also here, you could build something like that yourself, but there's plenty of good tools out there. It will be much cheaper and faster if you buy one of them.
Is that a requirement in Europe?
Well, unfortunately, there is no one-size-fits-all answer. Not even a lawyer will give you a completely black and white answer to that. Out of personal experience, I would say when you have investors sub 1,000 euros, then you may not have to KYC them at all. If you have investors between like 1,000 and 10,000 euros, you may do some kind of a light KYC where they perhaps send you like a scan of their ID card or passport. Above 10K, I would do a full KYC to be on the safe side. And you will probably even be required to do so by MiCA, where in Germany, for example, the standard is this very annoying video KYC or potentially other methods. So it depends a little bit on the ticket size of the individual investor and also of your total fundraise. It makes a huge difference whether you raise, I don't know, 200,000 euros in seed capital or whether you raise 20 million because you are a relatively mature company. So this is always a risk kind of assessment, both on the investor and on the total raise. But there's probably not a scenario where you don't have to do any KYC at all under MiCA. So be prepared to do some kind of KYC, even if it's more a lightweight type of KYC where you just ask for the full name, address, etc.
How does it work with DEXs? If, for example, I have my token right now on Radium and everyone can just put capital in there, how does the KYC or the KYB work?
Well, that's the secondary trading, right? We're talking about the so-called primary issuance where you initially sell tokens that you created and sell them to the general public, right? So that's your obligation in the, as it's called, the primary sale. The trading that happens and the buying and selling that happens on the decentralized exchange, that is secondary trading. If Radium was not decentralized, they would be regarded something that's called a multilateral trading facility, and they would need to do KYC for every market participant, so for every buyer and seller that is active on their exchange. But them being decentralized, they can kind of evade those regulatory requirements.
One question.
Yeah.
So if I put all my tokens to Radium, and then the people are just buying on the secondary market, I don't need to make KYC?
Very stupid question. No, but I mean, what means putting them there, right? Do you mean selling, or do you mean just giving them into the exchange for free?
You can provide liquidity with most of your tokens, and then the other. Those who want
Yes,
to
you can do that,
participate
yeah.
can exchange, yeah.
But at the end of the day, everything is a risk assessment, right? So you have to ask yourself, will the regulator accept this as a good method of raising capital, or will they at some point ask you, you raised 2 million, we can see your cap table because it's on the Block Explorer, and the top 10 holders, each of them holds, I don't know, 200,000 euros worth of tokens. Now tell me, who are these investors? Because for anti-money laundering purposes, we need to know that. And if you then cannot answer that question, chances are they will sue you. Worst case, you end up in jail. So at the end of the day, it's your risk assessment, right? How much risk are you willing to take? And do you think that the regulator and ultimately law enforcement will believe you and trust you? Or will they say, well, you went too far? There has been some illicit transactions going on with the token. We suspect it's money laundering. We now need to know from you, who initially sold those tokens to the public, who are these people?
So in the end, as a business, I want to provide the government or the regulatory body as much as answers, so they will be satisfied and I can run the business.
Yes, that's a good way to sum it up. Two more aspects around operations, and then I would say let's continue. You will need customer support, or you can also call it investor relations, because not every investor will go to your website and spend 100,000 euros on your token. They will have questions. They will see your white paper, they will see your marketing material, and before investing, they may have questions. And it's good practice to communicate with your community. And the more publicity you have, the more interested users and investors you will get, and the more questions you will need to answer. You will have to prepare your team to answer questions. What we did, and this is very common practice, you have an internal FAQ so that your customer support team is ready to answer questions, and you will see that questions start to repeat from different investors, so you can extend your FAQs. But be ready to communicate with your community. As I stated at the beginning, when you are ready for a token sale, ideally you will already have an active community, so you will be experienced in managing that community. But again, when you do a token sale, you will, just do a lot of marketing, and you will probably have a lot more activities. So you will need to ramp up those resources if you do your job well, and if you have a lot of inbound interest. And you will need to have a website, marketing materials. So be ready to do these operations. And again, do that ideally in a lean way. Don't start to create everything from scratch, because you can go deep into these topics, but they don't really add value to your actual product and to your marketing. So try to take as much ready-made solutions as you can, instead of trying to reinvent the wheel. This is, by the way, what a token sale investor interface can look like. This is from a sale that raised through the Bitbon token sale smart contract. They raised $1.1 million in USDT. If I was one of the investors here, I could log in with my wallet and then claim the tokens from this interface, because this is the next step that happens after the sale. The investors will need to be able to claim the tokens. Now, there's generally two options that you've got here. On the one hand, you could create a token sale contract with one of the generators, like us with Bitbon or CoinTool, and there's a few others out there. I recommend you to simply compare them. In this case, you are super independent. What people do is they embed this interface as an iframe into their website. They have their community, and they go out and raise capital. That's exactly what this example, what Conway did. If you don't have a community, but you say, well, I'm still very confident about my product, I make great revenues, but perhaps it's an enterprise product, so I don't really have a big retail community, I still want to do a token sale, I feel like I'm ready. And one thing that you can do is you can go to a launchpad. A launchpad is essentially a website that doesn't just provide you with the token sale smart contract, but they also have an audience where people are regularly going to these launch pads because they want to invest in early stage tokens. This is great The downside is mainly the cost. It's typically 5% of funds raised, which is pretty substantial. So you have to think about what is the right setup for me. Two of the better launchpads are Fjord Foundry and VXApp, but also here there's a big selection of launchpads. And as with everything, I would recommend you to look at, what's available in the market and what is the best fit for you. Yeah.
I remember Tokenizer presenting here once, and they also highlighted as one of the advantages of token-based fundings that in some configurations the investors can decide by the time when they claim or by the factor of the time when they claim the funds to also dictate when a taxable event happens. And that would be a major advantage compared to many other funding opportunities. Is that applicable here too?
I mean, this is not really related to the underlying infrastructure, but to the legal setup of your token offering. So what Tokenized have done is they have found a pretty smart way to invest into German limited companies. GmbH is the kind of German abbreviation, but at the end of the day, it's a limited company, which is extremely illiquid because every time you buy and sell shares in this German limited company, you would have to go to the notary. They have found a pretty smart legal setup where you don't need to go through the notary, but you can do that in a tokenized form. And that also has tax implications. It's something that you can consider in your token setup, but again, this is related to more to the offering material part and how you structure the token from a legal standpoint. And frankly, I'm not a tax expert. This is something that you may want to consult with a lawyer or with a tax advisor.
This came to mind because I was originally asking myself why you didn't structure it as an airdrop, but rather as a claim, because it would be a better user experience. So I thought maybe the reasoning for that would be to offer the investors the opportunity to claim at a point in the future where it favors them tax.
The claim has technical reasons. So you could, in theory, you could do it as an airdrop. I don't want to make this particular part too long. If you did that, it has a lot of technical challenges. And it's very common to structure that as a claiming process instead of an airdrop. That's the short answer. I'm happy to discuss that over a drink later. Let's come to the fifth out of 6 parts, the marketing part. This is super important. Founders often think about their product, then they think about this whole white paper topic, about the token design, etc. But marketing is at least just as important as these other topics. Because you may have a great product, a great token, it may have great utility. If you don't have a good marketing plan, chances are nobody will buy the token. So think about this early on, and think about this in parallel as you solve the other questions and topics in your token sale. When you start to think about marketing, one of the first things to think about is who are your target investors? Who is your target audience? Because that will define most of your other marketing activities. So think about, is this a crypto native crowd? Are these people who hang out in crypto Twitter, on Telegram? Are these rather mainstream investors because you may have a product that everybody is familiar with, whether they use it or not? So is this something that's more mainstream? Is this something that's rather interesting to larger professional or institutional investors who can help you sell the token? So defining your target audience is very important. You may not be able to do that with 100% accuracy because obviously at the end of the day, you will try to sell your token to everybody who is interested. But it definitely does help to structure your marketing plan because ultimately marketing costs money. It very rarely comes for free, and you will need to decide where to allocate the scarce resources that you have. Then once you have defined your target audience, you will put together your marketing material. One of the core parts, of course, is the white paper or the prospectus, depending on whether you go for a utility token or a security token. But then you will also create a light paper, which is more of a glossy marketing style, shorter, more visual version of the white paper or of the prospectus. So this is definitely 2 initial documents that you will need to have. Then beyond that, you will want to have a website where you present your team, your roadmap, the tokenomics, you explain the product, you explain what you are going to do with the funds that you raise, etc. And then further marketing material like merch if you plan to participate in events. So here you have to be creative, right? Ultimately, this is an attention game, and you want to get as much attention to your token sale as you can. And then once you know what your marketing material looks like, you will want to define where to market and where to reach your target audience, so the channels that you're applying. The first, and in my experience, by far most important one is the community that you already have. And you will want to work with that community by engaging with them on social media, by sending them newsletters, doing webinars, informing them, nurture your community. This is the #1 source for buyers and investors in your token sale. Beyond that, you can also do guerrilla tactics. We did a pretty cool bounty program. At the time, quests weren't so popular yet. We used Bitcoin Talk, where almost every ICO at the time went to Bitcoin Talk, posted a big bounty program, and then hundreds of people would help you get the word out about your token sale. Might not work for everybody, but you have to explore these kinds of options. Quests, also airdrops can be extremely helpful. Uniswap did a huge airdrop, for example. So when you already have a community, you could also say things like, if you participate and are eligible for the airdrop, then you may get an allocation in a token sale at a preferred price, etc. So you have to be really creative here. Ultimately, what you want to do is get a lot of attention, create awareness, and make people excited about your token sale. Then there are ICO calendars, so you can list your token sale so that people who are generally interested in participating in token sales will discover it. And then there is a huge chunk of paid marketing, which typically is very, very expensive. So you have to be careful here what you're doing. You can do PR. PR is not free. Of course, you can send out a press release, but if you don't do that with a PR agency, chances are very little that some of the bigger publications will talk about you. You need a compelling story, and you need professionals to help you get the word out. If you work with influencers or KOLs, as they are often called, they will often also not do that for free. Of course, sometimes you might have a good relationship with one, and they will want to do you a favor. Most of the time, though, they will not do that for free. You will have to pay them, or bigger YouTube channels, etc. When you run ads on websites or in their newsletters, something like CoinGecko, for example, or this would be one of the bigger and more expensive ones. But on sites that talk about crypto investments, these are very good outlets to advertise your token sale. But again, this is super expensive, so you will need to make sure to have the capital already for that, or you will have to be very economical with how you allocate your resources. You can do sponsorships. You can do partnerships. Again, all of these things cost money. You can get a CEX, so a centralized exchange listing, but also these things are very expensive. This can easily go up to 200,000, 300,000 euros when you want to have a guaranteed listing before you launch a token. There's also a long vetting and onboarding process. So again, the best thing that you can do is nurture your community and have them be so excited about your product that they will want to buy the token once you release it. All the other things cost a lot of money. And even the launchpad, like I mentioned before, the launchpad will have some fixed upfront fee and then will charge you 5% on the funds raised. Any questions about marketing before we go to the last part?
So you estimated the total marketing cost, including Jax's, would be around $350,000.
No, but what I just mentioned was when you want to list on a centralized exchanges, these are the listing fees, right? I mean, in theory, you could run a token sale without any paid marketing, right? If you have a large community, then they will potentially be able to invest, I don't know, 2 or 3 million into your token sale, and then you don't have any costs at all. But again, some ICOs in the past have used the fact that they have a guaranteed listing on a centralized exchange as a method to do their token sale. One example that is a bit more recent that comes to mind is LimeWire. I don't know if you know LimeWire. It used to be like a MP3 file sharing platform back in the 90s. Then the brand was more or less dead. And then there was a new founder team that has bought the brand, and they have launched a new platform under the same name. They created the token with Bitbond, so that's why I know so much about it. But they had a pretty good story, and they secured a listing with Kraken and I think 1 or 2 other centralized exchanges. But I'm pretty sure they didn't get that for free. They raised some initial capital from seed investors, so not from a public token sale, but they secured some capital to have for these exchange listings, and then they did a token sale, which was pretty successful. I think they raised around about 10 million in their token sale. But again, one of the marketing tools that they had was the listing that was already guaranteed at the time, because then investors knew, okay, this token is going to be listed. There's a good chance that after it gets listed, the price will go up because some people who missed the primary sale will want to buy it on Kraken and on other exchanges. And that's why they were able to attract so many investors.
I have a following question. Isn't Kraken a US exchange, so they are in US?
Yes, they are.
They also have to pay these regulatory fees and everything else.
Well, they are not listing any securities, right? There's not one single regulated security listed on Kraken. It's only cryptocurrencies and utility tokens, maybe DAO tokens, but none of the tokens there is a security token. Good. Let's go to the last part, execution and post-sale. Don't be that blockchain ICO company which has a very fancy white paper, promises everything, and during the production implementation it starts to fade a bit, and then the actual release is far away from what you promised. Because you are making promises, even if it's not a security, even if you have just a utility token. People will buy it because they believe in you as a founding team, they believe in your product, they believe that they will be using your product, and with that will help generate demand for the utility token so that the price will go up. Deliver on those promises, which means make sure to put together a plan with milestones for your token sale that also considers what happens after a successful token sale so that you can deliver on those promises. If you want to be successful, then this is definitely an important component of your plan. Now, for the sale itself, for the execution of the sale, one thing that I can highly recommend is to incentivize early investors to join early. Why is that? I have put together a very rough estimate of a schedule of a 14-day token sale. What happens is that typically around about 50% of the total investment happens on day one, because you gain a lot of attention, you are marketing your sale, and then those people who are excited about it, they can't wait to get in early, and then they invest, and that's where you captured typically around about 50% of the total investment amount. And for the next 13 days, almost nothing will happen. Typically around about 20% of the total proceeds will come in during that 13-day period. And then if you do your job well and your marketing machine runs, then on the last day, you can get another 30% of your total amount raised. Because the fear of missing out hopefully kicks in, and those people who have postponed investing into your sale will do it on the last day. And since the first day is so important, you don't just push very hard in terms of marketing, but you actually give them financial incentives by, for example, providing a discount to the very early investors. This is definitely something that I would advise you to do. You cannot expect that people will invest in a linear fashion throughout the sale. And then again, after the sale, deliver on your product promises. Really do that, because otherwise you will be in trouble. You as a founder, if you did that well, and if you listen to the tokenomics part, most of your tokens will be locked up. And of course, this is not just fundraising for your company, but you also want to have some financial gain for yourself. Since your tokens are locked up, they need to be worth something in 3 or 4 years from now, depending on the lockup period, right? If your token price just goes to the bottom throughout that time, then by the time your tokens are vested, they will be worth nothing. The way to prevent that is to deliver on your promises. Then you can also incentivize people to not sell the token early on after the sale. Because what can happen is, let's say you give a 30% discount on the price for the early investors. Then after the token has been released, you have let's say it was an IDO as I recommended, there's a liquidity pool. So on day one, after the token sale ended, they can start to trade through the liquidity pool. And if they had a 30% discount, maybe the token price in the liquidity pool is 20 or 25% higher than what they bought it for. So they have a very strong incentive to sell right immediately after the token sale finished. This can again cause the price to fall. And to prevent that, you could offer staking, for example. So you could say, if you don't sell your tokens, but you stake them in a staking contract, I give you, I don't know, a 10% annual percentage yield in kind of the token, then they have an incentive to not sell immediately. So this is one of the methods to apply to make investors stick with the token. And probably the most important thing after the sale has finished is to communicate. Based on prospectus regulations or even MiCA in the case of a utility token, you are almost legally required to do that. But even if you were not legally required to do that, I highly recommend to do that because, again, you have a vested interest in the fact that people are not selling the token because they fear that you as a team have disappeared. So communicate regularly, keep nurturing your community. Also, by the way, you may want to do another token sale at some point, in which case, again, you may want to leverage your community. So these are very important aspects, and the communication is probably the most important one. There's plenty of bad examples in the market how to not run an ICO. There's also a few very good ones. Aave is one that I like to pick out. They did an ICO. They did a pre-sale in 2017 for $600,000. That allowed them to have capital to run an actual ICO, which they did in October 2017, where they raised $60 million, which is quite a sizable sale. A lot of the ICOs, not just from that time, also from last year and from the years before, had a spike in price at the beginning and then the price collapsed. Aave have managed to become very successful. The market cap, even though the last days have been pretty difficult in the crypto markets, the market cap of Aave is still at $2.6 billion. So it's a very important and very large token, probably one of the most successful ICO tokens that have existed. So definitely a lot to learn from them. Again, there's plenty of others, but Aave is one that stands out where you can get very good learnings from. As I said throughout the talk, I had to condense a lot of the things. So what I recommend you to do, if you want to run your own token sale, look at some of the successful examples in the market. For each and every topic that was mentioned here, you will find a lot of material online, and it's worth investing the time and the effort into this if you want to do a successful token sale. So that's it, what I wanted to say today, and I'm happy now to dive in, discuss some of the topics that we spoke about. Any further questions or comments?
I have a comment about staking. Isn't it a financial return? So is there a regulatory problem regarding stake, which is totally legal?
As with every legal question, my first answer is talk to a lawyer. But the staking should not be a big regulatory issue because the token already exists and you're just giving out a reward. So you ask someone to do something, which is locking up their tokens, and as a reward, you pay them this token. So this is the same way, you're asking the delivery man to give you, to deliver a pizza, right? This is not a promise of a financial return in that sense, but it's pretty much paying them to do something, right?
I have a question still about the definition of utility token, because I've been trying to design one for a while, but It always ends up that you do a utility token to give access, for instance, to special features in your product. And I thought, okay, you can even not have the utility token and give access for USDC.
Yeah.
So is that the case, or is there something more that the utility token can have?
Well, first of all, it doesn't have to be special access. You can also treat every user the same and say everybody who uses this product has to pay in this utility token, right? You can tie it only to specific functions, but you don't have to. Now, I would say if you make people pay for a service or a product in the utility token, that's already sufficient to make it an actual utility token. But of course, you can always provide more, right? Governance is something that is very common. To stick with the Uniswap example again, the main purpose of the Uniswap token is a governance token. Uniswap operates as a DAO, as a decentralized autonomous organization, and the DAO participants can submit proposals, for example, for protocol changes in the Uniswap protocol, and then everybody who holds the Uni token can vote for or against those proposals, right? So this token gives you voting rights, right? And I would have to double check that, but I don't think that the Uni token has any specific role on the Uniswap DEX, on the decentralized exchange, right? Again, I may be wrong, but I'm relatively sure the Uni token doesn't really play a role on the DEX itself. It's rather a governance token, which again is still a form of utility, which lets you vote for or against these proposals.
In fact, for governance, I find it very useful, actually. I wouldn't be able to achieve the same by having dollars. Like, who has more dollars has more votes. That would make sense. It's just for when you want to provide features, even all the features with your token. It feels like you're basically artificially preventing people from paying you just because you want to give value to the token somehow. Or maybe Binance is the example. Like
Binance, for example, give you a choice, right? On Binance, they ask you when you do a trade, should this be deducted in dollars, or if you buy Bitcoin for dollars, for example, should we deduct the fee in Bitcoin, or do you want to pay in the BNB token, right? So they give you a choice. It's not a hard requirement. So it really depends on how you design your product and how kind of how big of an intervention is it? You know, do you think if you make the users only pay in your utility token, will that scare away users because that's not, you know, good for the UX of the product, or does it kind of fit in naturally, right? So it really depends on your token design, on your product design, and how you want to do the UX.
Okay, thank you.
I wasn't able to follow the questions online so much. Is there anything we should take a look at?
No, I don't think so. There's salutations, everyone from the States.
Thank you. One more question over there.
I'm sorry if I missed the question earlier, someone posed it. What I'm asking is, how and with which token do you ideally connect internal company KPIs to what you're doing to actually prove the value you're creating to increase trust?
I'll give you an example. We're currently talking to a company that is planning to do something. You can think of it as a YouTube channel, right? One of the goals of a YouTube channel is to get their subscribers and the views up, right? And what they want to do is they want to tie the value of the token to the number of views that they are getting. I'm slightly changing the concept, but I think you get the idea. but there they promise to buy back the token at a certain price if they reach a certain number of views, right? And of course, the views is a top-level KPI for the company, right? And so they are tying that because what they want is they want the token holders to have enough incentives to, first of all, consume the content themselves, but also to talk about it so that others are consuming it, so that the tokens that they have will go up in price. So this is definitely a, let's say, feasible method to tie the value of a token to a top-level company KPI. I'm sure if we took a few minutes, we could think about other examples, but this is one way to do that.
But if you promise to buy back tokens related to your KPIs, doesn't that put you squarely in the securities camp again?
Not necessarily, because you are buying back the token. You're not giving something to the token holder, something like an interest, because they don't get to keep the token. They have to sell it back to you. They are also planning to do this during a certain phase, which has an end, and after that, the token will be freely tradable. They want to use that as kind of a ramp up before the token goes and will be tradable on a decentralized exchange. But there's definitely plenty of creative ways to tie tokens in some way or the other to top-level company KPIs. The biggest, let's say, caveat here is, are these KPIs verifiable? The good thing about YouTube views is they are publicly observable. Obviously, you can tamper with them because you can artificially pump those numbers up. But in this case, the company would not really want to do it because they have to pay a higher price for the token. So they want to have actual views, because ultimately, why do they want views? Because they want ad revenue from these views, right? If they produce the views themselves, then it will not really generate ad revenues for them. So the incentives are aligned. And I think that's the most important thing. The incentives have to be aligned. The people who are buying the token have to credibly believe that, as these KPIs go up, they have not been tampered with, but they are true and really will be tied to the value of the token. And I think that's the challenge here, to find KPIs that are publicly verifiable and that are extremely hard to fake. Sorry?
Views are very easy to fake.
Yes, but not necessarily in a way that it's aligned with the incentives of the company, right? Because I think if you are buying views, then you are probably paying more than the ad revenue that you generate from it, right? So you would not really want to do that. I mean, I'm not a huge YouTube expert, but I suspect, buying views is not free, and I don't know how much ad revenue you actually get. So
The ROI is not big, but it's very common. Channels want to grow fast.
Probably a lot of channels are doing it just to, increase their visibility. But I'm sure it comes at a cost. Great, then I would say we can probably wrap it up. Thank you all. Thank you all for participating, for the great questions. And we are going offline as well. Thanks for joining.